Hi guys, it's Josh here from the Health and Wealth Group. Today we're going to talk about why you should start investing in the stock market. So we've already covered what you need to do to get started on your investing journey. So we've discussed setting up a budget, working out your surplus income, setting up an emergency fund, setting up some new accounts to start funneling that surplus income into, then setting up your direct investment account, so then you can get started in investing in the stock market. So let's look at what the benefits are of investing in the stock market and why it is such a great avenue for millennials to start investing in. So one of the biggest things you need to learn is over the last 90 years, generally the stock market has returned 10% per annum. So we all know that the stock market goes through some bad times and hits some bear markets, but overall, there's always a good return on your money over the long term. So the average return for long-term gains is roughly 10%. So how to compare that? On average, let's say a bank, you want to put your money into a bank, into a fixed term deposit. For an average 5-year fixed term deposit, you might get 2.5% return on your money, barely covering the rate of inflation. And worse, if you keep your money in cash in the bank, it'll actually depreciate in value due to inflation. So millennials who've got some time under the belt to invest in the future, stock market is such a great avenue to do it in. Now, it's easy to get started is the other really promising factor too, to make sure that this is the right way for you to go. So as I said, once you set up your direct investment account, whether that's with your bank or if it's with a private online broker, it's easy to get started. Once you've got a bit of savings coming in and you've designated that into your investment account or your freedom fund, then you can start putting it into your investment account. So there's no minimum of what you can do on the stock market. You can buy as little as one share. So there's no 5,000 minimum deposit. So that concept of I don't have enough to get started doesn't exist in this world. So that's the first problem we've overcome. There's no minimum entry. Now I don't recommend buying one share, but it can be done because there's always brokerage fees and we want to minimize your fees. So that's the next point. We want to avoid paying someone to do this for you because they take a huge chunk of your overall long-term returns. Now, they might say they're going to take 1, 2, or 3% of what they make you, and if they do well, they'll take up to 20% of your profits. So it's overall, when you're thinking about year-on-year compounding interest, they may be taking 3%, but that 3% turns into 6% and 10%, and in 20 years, that's 30% less that you're going to have in your investment account. So the way to get around paying a mutual fund manager or a fund manager or an investment manager or whoever it may be, a financial planner, is invest in yourself, get your basic knowledge. And then we're going to look at, instead of picking individual stocks of businesses, which is really hard to do successfully over a long period of time, we're going to look at index funds. So index funds, what are they? Basically, index funds are a basket or list of stocks that an analysis company puts together to track an overall basket of stocks. So you might have heard of the S&P 500. So that's the top 500 stocks in the American business market. So in Australia, it's the ASX 200. That's our top 200 companies by market capitalization. So basically, you can invest in those index funds. So instead of having to pick stocks, or if you feel confident in the business sector or the finance sector or oil or commodities, you go and invest in the top 500, and you don't have to worry about which companies you're picking, because those analysis companies like Standard & Poor's, which is the S&P 500, they do it for you. So if a company doesn't make the cut, they fall off that list, and then another company pops on that is doing really well. So that's the joy of index funds. So you can get great diversification by simply investing in one stock. So that makes it easy to diversify, which is our next point. So as I said in an earlier video, we want to look at investing in shares and bonds and property. So how do you do that with stocks, you say? So as I said, index funds. So you're going to get good diversification if you invest in the top 200 companies in Australia. So they'll have, that'll cover property, that'll cover finance, it'll cover all of the industries that'll give you diversification. But you can go one step further. So you can get bonds. So how do you invest in index funds on the stock exchange, you may be asking? The easiest way to do that is called exchange traded funds, or ETFs for short. So they are funds that are managed by professionals that are then listed on the stock exchange for you to be able to invest in. Now the management fees are like 0.3% up to sort of 2% if you pick a really bad one. But these exchange traded funds, they'll offer you these index funds to invest in. So that's how you get great diversification, and you can actually get broad asset allocation across all your different asset classes simply by investing in stocks, and that's how you create a diversified portfolio. So there's always going to be bear markets, there's always going to be the media pointing out there's bad things happening in the economic cycle, but if you play for the long game, you do your research, you have a plan, and you have a diversified portfolio, the stock market is a great place to get good returns on your money. So in the next video, I'm going to go further into index funds and how you can buy them in ETFs, and how easy it is to diversify your portfolio and have great asset allocation. So thanks guys, see you soon.